Hey everybody, good afternoon. Welcome to 12-Minute Trading. My name is Doc Severson. I'm joined by Dave Lukas here. Today is Monday, the 23rd of September. We are into the fall season now in 2024. And guess what? We still have a rally, just like pretty much the rest of the year. It is resolved to the upside. So we are in this big consolidation pattern, which started in mid-July, and we got some shake and bake through this. Got lots of fun over the last couple of months, and pretty much the whole roller coaster. But we have broken out to the upside. So, Dave, what are you seeing right now? What is this going to continue going, or is this just a pop and drop?
No, I think it does. I think the weekly charts will show those are releasing higher. We've been talking about that for the last few weeks. We've basically been in this kind of chop zone, this big chop zone, for a while, going nowhere. And it looks like we are breaking out of that now. I think right now the daily charts are pretty exhausted, so we're kind of flagging, right? We're kind of seeing one of those flag patterns that we've been seeing and off these moves. And then typically what we've been seeing after that, at least for now, we've been seeing kind of a pullback to a higher low, and then we go higher from there. So this is all still very much a bull market. We've had more chop than we're probably used to, like in a typical bull market when you have multiple 4 to 5% corrections in a very short span of time is a little different than what you're used to seeing. But overall, we are going higher from right to left, right? And so that's kind of where we are overall. We were talking earlier. I think this market runs through the end of the year. And I think this market runs through the end of the year because when it comes to the election, both are really known commodities. Trump's actually more of a known commodity than Kamala because she hasn't put out a ton of policy yet. But in reality, what's going to change much from what they're currently doing? Maybe they put a little bit of it on steroids if they can, right? Depending on how they do with Congress. But for the most part, you're going to get the same type of policies and everything. So the market knows that. With Trump, they know what they're getting. They understand the tariff game, and they know he's going to do that. So it's rare that the market really has certainty on an election like this. Usually there's uncertainty, and so the market gets jittery, right, ahead of that. And then once there's certainty, the market rallies. Right now, we have pretty much certainty for the markets for the most part. So I think we probably take this weekly swing into the election. We probably maybe pause a little bit after that, kind of take it in, and then we run through the end of the year like we typically see in that fourth quarter and get that, end of November through December run, right? So maybe we walk sideways for a few weeks in November after this, get that, last push higher. And then as we've been saying, the underpinning macro is still deteriorating. And so in 2025 is when I think the turmoil really starts to happen. And if you notice, with the way our debt's gone like this, the boom and bust cycles are happening faster. We're getting more big, corrections followed by big booms just faster, like every 2 years now instead of every 5 to 7 years, right? So it's just that type of world that we're in. So we're due for the next one coming up here in 2025. So that's kind of how I'm seeing it.
Yeah, it's what I'm drawing here on the monthly chart is what's essentially a megaphone pattern. So like you were talking about, the volatility is expanding. It's getting bigger. So when we have uncertainty, it's the bust cycle. It's big. It's big, and we're in big numbers. So when we have a 20 to 30% drop on the S&P 500, that's a huge. We're talking multiple dozens of trillions of dollars. When we swing down something like that, just like when we have boom cycles are incredibly large with this because of all this liquidity sloshing back and forth in the market. So
and it happens faster.
And it happens
faster, and you correct faster. You know what I mean? And it's over faster than in the past.
Yeah, I was surprised how quickly the 2022 bear lasted. It really was only just about 12 months. It was one of the shortest bear markets that I can remember. Now, we didn't really classify it back into a bull until about 18 months or so. So it did take until the summer of 23 before it finally got out. But the bottom was only 9 months in. The bottom was 9 months in, and then it
Yeah, if
reversed
you
right off
remember
of it.
though, in October 2022, once we came out of that and got into December, you and I were both saying, okay,
Yeah.
this is looking like it's flipping back. So, and yeah, I think you're right. We got the confirmation, fuller confirmation later 2023, but I think we saw it kind of shifting its, changing its character at that time. And that's the thing that's the thing right now. I think one of the most important skills as a trader is recognizing character change because it is happening faster and faster. In fact, if you just do just a single chart on the monthly for like the last 20 years and look at the way the character is changing so much faster in the last 5 to 10 versus before it.
Yeah, you can see, this is a 20-year monthly. And so here was very quiet tape. And then here was,
Yeah, look at that '09 through 2020, type movement, right? So there's your '08, which is and look how long it took to go through that bear versus what we were just talking about. And then you had to just slow grind for like a decade before you got your next. And now it's getting, look how much faster and more violent the moves and swings are either way in these markets.
yeah, the slope is actually increasing. And so one of the ways that you can actually account for this is, I got to remember how to do this now, is if you go to the log chart. So if you go to the price axis and use a log scale for this and apply that, all of a sudden it just makes more sense. Mm-hmm. And so if I go back through not just 20 years, but if I go max available on this thing, this is where it actually makes a lot more sense. Now, price adjusted, I mean, we're talking about $10 on the S&P back here, but now we're at 5,700. The same thing is going to happen in 10 years. We're going to be at S&P 57,000 in 10 years. Mm-hmm. Now, don't quote me on that, but just for example, if we extend this out, this is going to go way above there. And so we're not really ready for this. Now, it makes a lot more sense if you debase the currency, if you just keep printing and printing and printing, and where the actual currency makes no difference. So this is everybody's in kind of a race against time right now.
Well, that's effectively what you're seeing, though. This is just a great showing of the devaluation of the dollar over this time. Yeah, it's not absolutely. That these things are gaining that much in value. Some stocks and stuff are, like the Nvidias are, obviously gaining in value and worth as a company. But overall, what you're really seeing is just the devaluation of the dollar. Right. And that's what we talk about. You have to have velocity of money. If your money sits, at all, it's just dying. It's just getting lost to the ether because of inflation and just the devaluing of the dollar. From 1971 up until 2021, the dollar had lost 98% of its purchasing power. Do you realize that it's lost over 25% of what was left since then? And so that's why do you see the market going up at a faster, more parabolic clip? That's what you're seeing effectively in the charts. And that's why over time, left to right continues to go higher. The natural upward bias is there. You just have more violent swings that you have to deal with, right? Like one of the best ways to trade is literally just sit there and sell puts against the S&P 500, honestly, over time. But you're going to have to deal with those times where it does come down 30-40%, and in a span of shorter time goes back up again. But if you just do that consistently over time, you're going to do well. If you take the stock when you get it put to you and just hold it and do that, you can do really well with that. It just takes a lot of coin to be able to do that for most people, and they don't have that,
But that's a great point, because I think we're going back into, now we're not going back into zero rate structure again. I doubt that is going to happen. But the point is that you can't just sit in a savings account. So people will be like, oh, 5%, we're back to 5%. Guess what? If inflation is running, a multiple of that, then you're still losing money on opportunity costs. So you've got to have, and we've been saying this for the past 10 to 15 years, You cannot simply, they changed the whole thing back in 08, 09, and
Yep.
especially with 2010 with the adoption of quantitative easing. All of a
Yep.
sudden, they made a conscious decision to basically screw over the savings class. You have to be in the investing class if you want to retain par value with what's going on.
Savers or losers in this environment, unfortunately. And so, again, yeah. And now that they're dropping rates, that 5% you're getting is going to go down too, even there, right?
Yeah, the risk.
Now, it doesn't mean like if you got a brokerage account and you don't have money that you're effectively putting to work in, whether you're selling options or buying stocks or whatever, that you can't put it in something like a BIL or something like that to gain a little bit of interest while you're doing it. But you really should keep it moving as much as you can, right? And that's again why, and maybe Doc, that's what we concentrate on for a few minutes, and you're the best at showing this, is understanding the character change of markets, because you have different trades for different characters of market. And if you get really good at understanding the changes in character and then applying the strategies, you can keep your money working no matter what the market does. So take us through real quick, take everybody through just the character changes of markets as a little refresher, and we'll talk a little about the strategies that make sense for those.
Okay, I'm gonna pull a GE here and set up a 2x2 matrix.
Mm-hmm.
So let's see. We'll do this, and we'll do that. Okay. So if you look at things on the scale of actual, let's see, it's going to be volatility and I'm blanking out here. Let's see. This scale is going to be you know what? I've actually got a slide for this, but let me see if I can work through this here. Okay, so volatility is going to be one of them. So, I know what I'm looking at here. This is going to be trend. So I'm just going to put a T on here for the amount of trend that we have. So down here is going to be lack of trend, right? So no trend. And then up here is going to be major trend. And then same thing here, volatility, actual movement. So when we have low volatility is going to be something like this versus big volatility is going to be something like this. So we're looking at things from a trend and volatility perspective. So when we have quiet volatility and sideways, we have periods of markets that are like, and I'm trying to find one here, that really we haven't had quiet and sideways since about 2016. So quiet and sideways is when, for brief periods of time, we really go nowhere like this. Yeah, that may be the only one that's on this chart is quiet and sideways we had for a few months there. Okay, so now let's take a sideways trend, and we're going to go volatile and sideways.
We've seen a lot of that lately.
Volatile and sideways is like periods like this where you have essentially no trend, but it slams around the place. And actually, we've had quite a bit of it here. This is volatile and sideways. Now let's go trending markets. So this is where we have quiet, volatility, and trending. And this is what we have for the majority of the market. So the majority of the time, we're quiet and trending. Quiet and trending here. It's quiet in terms of the volatility. It doesn't move a whole lot, but the trend is certainly very, very linear. And we may be transitioning back into quiet and trending now. Here's a great example of quiet and trending. Very low volatility. Look at the size of the candles here. They're pretty small candles, but the trend is very persistent. All throughout 2020, the end of 2023, the beginning of 24 was a great example of this. And then when we combine both of them together, we have volatile and trending and that is also called a bear market. This is where we have wild volatility, but it's trending to the downside. Okay. So the obvious thing here is that once you're in quiet and trending, you usually know about this because it stays like this for months at a time. And this is what you're going to see the majority of the time is quiet and trending. And so we have one set of strategies that works particularly well for that. But what you've got to watch out for is the transition. You're always going to have a transition over into volatile and sideways. So quiet and trending always moves into volatile and sideways. Now, once you're in volatile and sideways, this is where it's flying around the place. You might transition back into quiet and trending again, or you might actually go into volatile and trending. So here I can't erase this, unfortunately, because I'm going to lose the graph, but at the beginning of 2022, we made a transition over to volatile and sideways. And it started to unfurl to the downside. Here is where, at the beginning of like April, is when it really broke. And this is where Jerome Powell said, I'm going to keep raising rates. So we're heading for 2% inflation and we're going to do whatever's necessary. Markets sold off like crazy, right? So that was every time. That was a transition right there in April of 22 to volatile and trending, bear market territory. Now, eventually what happened is it went into volatile and sideways and then quiet and trending again. So to net things out for you guys, a second order skill for you, which will pay off huge over time, is to not only, number one, understand what type of character that you're in, but number two, what does it normally transition into? What do you have to be watching out for? It doesn't randomly just pick one of these. It always goes into the same progression back and forth. So it's not like you have, one of 16 different characters that it's going to fall into. It's one of 4, generally one of 3 here, and it always follows the same pattern every time. So there's certain things that you can look for to identify the type of transition that you're seeing, and when you're transitioning into maybe a third one, which is what we had at the beginning of 2022, and transitioning back halfway through 2023. And that will, like I said, that's a second order skill that will make a tremendous difference in your trading.
And we got spoiled from like 2010 through 2020 because it was pretty much a quiet and trending market. So it was really easy to trade in that environment. But now we're moving through these at a much faster rate, it seems. And some of that's probably due to zero DTE. It's due to the debt that we have and the financial engineering that goes on with it. Obviously the Fed, all these different things. But I think that's why this skill is so much more important now than it even was in the past, right? We kind of got lulled to sleep a little bit. And I just think we're moving into a time where look at the chart for the last 6 months. I mean, it's it looks like this, but it's still going higher, but it's more volatile and trending on a larger scale, right? And so that's for example, I'm looking for us to get back into quiet and trending through the end of this year. That's kind of what I'm looking at now. I think we got a weekly swing that's kicking in and going to take us through that. And we're going to go, more quiet and trending, kind of just continue higher through the end of the year. It doesn't mean we won't have any pullbacks, something like that. We'll probably have, a few, maybe even around the election, just some jitters and stuff like that. But ultimately, we're gonna just kind of meander on up through the end of the year. Once we get into January, February is when I'm going to look for that change to volatile and either sideways or volatile and trending based upon seasonality, because that time of year is typically more volatile. And because I do think that the macro deterioration that's happening out there is going to catch up. And I think the Fed is repeating the same mistakes in the past that are going to lead to a second bout of inflation again. which is typical. And it won't help that it looks like all the dock workers on the Eastern Seaboard ports are about to go on strike, which I believe they said is worth every day they're on strike is basically a week lost with goods and services and everything. So if they're on strike for 14 days, that means it's 14 weeks before things are unwound, which takes you into basically 2025. So there's just a number of things out there that I think will continue that deterioration. And so that's what I'll be watching for. Now that we've gone through that, Doc, let's just give one example, like a trade for each one of those. So for example, quiet and trending higher, really easy to sell puts and put spreads, right? It's really easy to do that. And something like the campaign cash flow, the campaign strategy, the campaign cash flow, it's like it's just easy money in that type of environment.
Yeah, it's like printing money. So we're not chasing the trend. We're not opposing the trend. We're going in sync with the trend. We're just like jumping on this big, huge whale and just taking it for a ride. There's also long strategies that we can do.
Mm-hmm.
So we use things like the modified synthetic longs, where we not only sell a put, but we also use those assets to buy a call option and then go for a ride and take this thing on a very, very low risk basis. Take this thing for a ride as long as we can. And that's where we can, make some big gains. So like, it's important that you not only have an income base for your strategies. So everything should be based on income, because income is the most important thing that you can do. But also, I mean, there's certain times in a baseball game where it really pays to swing for the fences. Mm-hmm. So you can play small ball, you can bunt, all the way around and manufacture a few runs. But if you've got guys on base and you got no outs, then swing for the fences. See if you can park one out of there and rip the game open. So we also do those kind of things. Now, when there are certain signals, and this is definitely more advanced skill, but there are certain signals that we look for, and you've heard us talk through them before when we do these Monday sessions, where we're getting a little bit stretched to the upside, right? So this right now, where we are is we're just leaving a pattern, so the risk is fairly low right now. And if it does fall back into the pattern, we can
right.
Yeah, because you got to watch out for throwovers and those kind of things. But when we have an extended pattern that goes on forever and ever and ever, it follows some usually pretty obvious cycles that we see. We see price popping above the Bollinger Bands. We see exhaustion signals on the larger time frames, and it will go just a little bit further before it finally collapses in a heap. And that's typically when we back away and say, okay, we're about to transition. Mm-hmm. And so that's very important as well.
And a good time of that's like when a weekly chart gets into exhaustion.
Yeah.
That's a really good time, a good signal. The daily chart, not so much, because that's working within the larger time frame. But when you get a weekly chart that's running on parabolic and gets to exhaustion, it's always going to last longer than you think it is. So like you'll see the weekly chart in exhaustion. It may be an exhaustion for a couple weeks before it really unfolds, but it's going to unfold back the other way typically when you do that.
The other things,
so that's a great time for that.
The other things that we see too are more intraday signals. So what you'll see is the day starting out, all rosy and bullish and everything like that, and the futures are up, and it maybe goes half an hour, pulls everybody in, and then all of a sudden you see the price just drop like a stone. Mm-hmm. And so that creates a reversal day where you have a higher high and a lower close. That is a key reversal, especially if it's outside of the previous day's candle. So those are little signals that you start to see at the very end of a run, where you start to see more and more of these reversal candles. Tops are a process. They don't immediately just drop like a stone, unless it's the pandemic. It was about the most violent drop that I think I've ever seen.
Yeah.
But, it's these little signals that you see. And we actually do go over these in our courses as well, too. Like the fractal energy trading course that we have has got all the transitions. It walks you through how to identify the character in the transition. So right. if you're kind of, trying to find your way through all this mud that's out there right now and try to figure out what's right and what's wrong, stay away from the news, guys. That's the most important thing that you can do. Learn how to build a price-based
Yeah.
analysis of what's going on. And that is,
Yeah. uh, Another thing to kind of looking at this too, transitioning to volatile and sideways or volatile and trending, which is typically maybe into a bear, is not a bad thing. Higher volatility actually allows you to sell better option premium and further out of the money. And so, like I long for the days where you had a more where like back 2010 through 2020, we had higher volatility while we were quiet and trending. Now we've got a VIX that hovers. It gets up to 20, and that's a big deal, right? Where that was like more the norm to be in the 20s for a long time. And so when you get a VIX spike, and that sort of thing in a quiet and sideways or quiet and trending, those are really great times to actually sell, like especially quiet and or volatile and sideways. Iron condors can do really well in that
mhm.
to sell into that. And so that's a good time to look at doing those if you know how to kind of place trades during in key levels and all that stuff. When you go to quiet and trending and you're going lower, it makes it really easy to sell call spreads and follow that down if you want. But also like you can buy puts against it, do kind of the opposite if you want to fund it. You can actually do the opposite of the campaign trade and go the other way if you want to during those times. But those are definitely the hardest ones. A lot of times it's best to kind of let it do its thing and then take advantage, right? And sell deep out of the money type of like put spreads.
You
After
know,
you've gotten a nice weekly exhaustion, to the downside.
the big
Great time for
the
that.
big
For
thing
put.
is also understanding when you're in a different type of character, how long and what kind of duration that different type of character. Like
Yeah.
like as you point out, like volatile and sideways, when you transition into that, it's usually pretty scary, but
Mm-hmm.
it's quick. Like
Yep.
we say, tops are a process, bottoms are an event.
Event. Yep.
Bottoms are it's like a singular event a lot of times. And lately we've been seeing these V bottoms, like V bottoms from hell. I mean, it's amazing. Just,
But
I mean,
what have we been watching for? We've been watching for higher highs, lower lows, and looking for that to break out of that to signal either quiet and trending again or
right.
volatile and trending, which would be resolving to the downside, right? And it looks like we're resolving to the upside, quiet and trending right now. And so that's what you're looking for. We didn't go anywhere, right? We had a slam dance for essentially a couple months in the end, but now we're looking like we're at higher. We've definitely put in higher highs, and we put in a higher low right before that on the charts.
So,
So
yeah. And guys, I will leave you with this one thing is like, so what Dave is saying is that here's our breakout level. And this is an ascending triangle pattern. So last week or a couple of weeks ago, we were in the same pattern at the end of August, like we were assuming a break to the upside and went into the opposite direction. But notice that it printed a higher low and a higher high. So it did actually reverse. It broke out of this pattern. Our measured move target is basically the open end of this, which is at least, that's a good 550 points of upside alpha that we're expecting out of this. However, keep in mind that if this pulls back down into the pattern, if this pulls down into 5,600 or let it, then look out. I
that's a
would
throw over, and it's just it's a trap.
Yeah. So, like, if you want to see an example of what these look like, here was one back here. So, look at this. We had the same thing happening at the end of 2021. Nice little, ascending pattern. Here's the breakout, consolidated for a week, and then went back down in the pattern. Anytime you go back down into the pattern from a breakout, that is a failure, and that creates one hell of a bull trap because everybody's looking for the long side and they don't know what to do when all of a sudden this is where people panic and sell out. So
No,
just
a great sign, and this would be normal because we're in daily exhaustion, would be a pullback right to that level of support. So basically, remember, former resistance now becomes support, and then from there you take off.
so
So even if it pulls back but if it pulls back and it holds at that level, which what is that 50?
it's about 5650 or so.
Yeah,
So
5650-ish.
so
If
what
it holds there and then starts to go, you are off to the races.
right. So what Dave is saying here is if it pulls back to something like this, But the thing I will say is that it's got to rebound off of this as though you have just touched a hot stove.
Yep.
There has got to be so much demand sitting underneath here, so many buy orders sitting here that, all these people that just went short have got to be, trying to get out like scalded cats at this point. And so
Yep.
that squeeze has got to happen. If it does not happen at 56.50, then it's toast. It's a breakout failure. And this could go all the way back down to this level.
So now for my students that are watching and stuff, now you know why when I said I was cautiously entering trades and position sizing lower than normal last Friday, because I'm seeing this and I'm saying, okay, it looks like it's starting to go. So we can dip our toe in the water, start to take advantage a little bit, but we still don't have, it's still not out of the woods yet. And that's what I said. Probably by the end of this week, beginning of next week, we would see that happen. And so that's why we dipped our toe in, but we're being cautious a little bit about it. We don't have to nail it perfectly, right? If this is a weekly swing that's going to go, it's going to go for 4, 5, 6, maybe 8 weeks through the end of the year. So we just need to, be ready for when it's confirmed. And I think by the end of this week, we'll have a pretty good idea.
Yeah, like today, I just an hour after my trading session, I sent out a second update saying, "Hey, I just hit 20% on my campaign diagonal. It's time to get out. Let's go to cash. We'll start again tomorrow morning." So we'll do this almost on a day-by-day basis where we're going to grab profits, we're going to book them. And if it keeps running, great. If it doesn't, if it drops to the downside, then we'll deal with that when that happens.
Exactly.
We know exactly what to do. So it's all about, it's what we always say, ABC, right? Always be closing.
Yeah.
So, hey guys, it looks like we're running a little long. So unless you have any questions, if there's anything else that you guys wanted to bring up to us.
And this was good. Hopefully this was helpful for you guys. This may be one of the most important sessions we've done for you in a while. If you really take it to heart and learn this stuff, it'll make a huge difference for you.
Yeah. And the resources are out there. It's not some, and everything is based on logic and understanding the psychology of the market, which is, I think, quite a bit different. Like we don't really base much of what we do based on trailing indicators and, hey, here's this special indicator that offers, a big edge to you, because 3 years from now, it probably won't work anymore. But everything that we do is basically based on price. And so this always, do we think the market will fill the huge gap formed last Thursday? Okay. So that's a good question, because we can, let's see, here we go. Let's go out to the gap chart. And we're going to look at, now I don't have all of these updated. They're not exact, like some of these. Yeah, some of these are okay. But I think, like here's some gaps that are down here. What about these? What about these huge gaps that we have from last October? Do we care about those? Does anybody talk about these big gaps that we have from October? No, nobody cares about them, because they're in the past, they're gone. Right, so we have huge gaps that go all the way back to the beginning of August. Nobody talks about those.
Look at the gaps in July to the downside. The end of those end of July, beginning of August. Look at those gaps that are there.
Those got filled. Those are filled.
The one got filled. The bigger one at the bottom, didn't come back and fill it. So the one that dropped into 5,300 range, that's still, unfilled, if you will, to the downside.
Are you talking about this one?
Yeah, that one right below there.
Yeah, so that was, these are, there's even gaps that go, actually, just about every gap got filled on the way back up. But as of right now, we don't have any upside gaps. We don't have any gaps that are above the current price. We have tons and tons and tons of downside gaps that have been caused by the price generally moving from the lower left to the upper right. And so those are always going to be there.
The answer to that is it does not have to fill the gap. Can it? Certainly. But it does. Gaps, just because a gap exists doesn't mean it is going to be filled. And so the answer to your question is we don't know, honestly. And that's why we're talking about watching this. Okay, we've broken out. Do we pull back to 56.50 and then that acts as support and we take off? or are we off to the races now? Are we going to flag out here? Right. So like this pattern setting up like a flag. Look at the last flag, which was the really the, end of August into September. Look at how we just went sideways for like a period of 2 weeks. Right. And that was because the daily chart got exhausted. The weekly needed to charge back up too. We now have a weekly charged up, which is this whole move up and continuing higher is the weekly, but we have a daily chart exhaustion. I think it'd be a smaller flag this time because it's just to charge up the daily chart. So that's why I think it goes through this week. And by the end of this week, we'll have a pretty good idea. And it should resume trend to the upside.
But
confirm it.
Notice also the volatility that's within this current flag. It's different from the volatility that we had with this flag, which broke to the downside, or this flag, which broke to the downside. So these are all flags. Here's some big volatility here, which broke to the downside. But notice that flags with smaller volatility tend to break to the upside.
Mm-hmm.
So that's another clue that we're looking at right now. The volatility is contracting. The realized volatility is contracting, which is another clue that we have. So I don't put a whole lot of, back to the question, I don't put a whole lot of weight into things that are supposed to happen just because it's happened in the past. So this is like the whole, the Stock Market Almanac, which is a book which is sold every year, and it's like, okay, on this date we typically have it's a losing day. 9 times out of 10 this is a red candle day. I can't trade based on that, and I can't trade based on, well, all downside gaps must be filled. No, they don't have to be filled. They're there because there was a supply demand imbalance. That's all there is to it. There's nothing more to it than a supply-demand imbalance.
Yeah, and make no mistake, last Thursday with the Fed is a 4-year event paradigm shift. So just remember, the Fed has raised rates and kept them there for 4 years. Now it is reversing that policy. So just that's a big deal, right? To go 4 years in one set and then turn to go the other way. Again, that regardless of what it does to inflation in the end, and let's say we get a big resurgence in inflation and stuff, the Fed has really signaled that it is cutting and it's going to probably stay there. I don't see them running rates back up, even if inflation rears its head again, partially because of the debt, because of the interest on the debt and where that's going. The other because I don't think they have the whats honestly as a group to do it, right? And so the market sees that and the market's going party on. And I think remember the other thing too, and I think this is really important. We'll leave it with this, I guess. The 4 phases of the market: disgust, disbelief, acceptance, euphoria. And you have to get into euphoria before you get that bigger, larger time frame, volatile and sideways to volatile and trending market. We are not in euphoria. Now, if we scream higher, S&P 6,000, everybody's making money, nobody can lose, celebrating every day on CNBC, popping champagne, doing all that stuff, you are in euphoria again. That is the time to be really, really careful. So again, if we go like this and go parabolic into the end of the year and are in that stage, that's when I will take advantage of it. But I will, when I feel we've and it won't be exact timing, but when I feel like it's like, okay, this thing is getting close to the end, this thing's going to pop, I'll just pull back, go to cash and just wait it out and see what happens. Maybe put on some, directional trades way out of the money, because volatility be like this, right? We'll have a VIX of like 8, right? So buying calls and puts, out of the money will cost you next to nothing. And you can turn them into 50 baggers if you do it right. Like that's the time to do that. So
big time. Hey, everybody. Thanks very much for joining us today. And I think we're going to be back next week. I'm not traveling anytime soon.
Actually, I am traveling back next week from Ironman. So this may be a solo show for you if you want to do it.
Yep. I'll do next week. So I'll see you guys next week. Get your questions in if you are watching this replay. get your questions in to support@12minutetrading.com, and I will address them next Monday. Thanks, everybody. Have a great week. May you all
Thanks,
be
guys.
profitable. Take care.